Thanks.
Yes, just to follow up on that point, it's certainly been argued by the banks that the reason for that big differential between base rate and what SMEs can borrow at is the sort of real world truth that you can't run a business on 0.5%, and therefore the margin is an actual amount of money as opposed to a margin, which seems to me to be a reasonable assumption, because, you know, as base rate goes lower, you still require a certain amount of money to be able to run your business, even though as a bank you might be borrowing at a very cheap rate price on a long-term fixed rate basis, for example. So is there the scope, and would it be straying too far into fiscal territory for the MPC, for example, to be talking about increasing base rate, but at the same time urging banks not to respond immediately? And obviously there's a huge differential right now between those who've got a fixed rate mortgage at perhaps 2 or 3% or 4%, and those who are on floating rates, who are hoping that, you know, what they're currently perhaps paying, you know, 3 or 4% for isn't going to suddenly rocket. And so, you know, there is, in the real world, you know, quite apart from the sort of theoretical macroeconomic world, there is a real disparity, isn't there, between what the banks are likely to do if base rate ticks up a bit and what we would need them to do in the economy, which is to hold their rates and to simply absorb those very small increases. Is that the job of the MPC, or is it the job of politics, or who should be doing that?
I have to say, I don't think it's the job of the MPC. I say it's quite strongly to say what the bank should do. The MPC would, of course, wish to take into account, when it's judging how far to push up bank rates, what it thinks the transmission mechanism will be. Certainly, during the time I was on the committee, one of the things we always looked at was how far any change we made to bank rate had been passed through into a whole variety of interest rates. And I should declare an interest here because I'm a non-executive director of a building society. One of the things that I'm sure all lenders are acutely aware of is that the people who have been borrowing on standard variable rates are often among the most exposed of our borrowers. And of course, when we finally see a bank rate change and we have to look at our book, that will be correct. You know, you would expect that to be taken into account, but I'm not quite sure that the government trying to affect it would be particularly useful in a sense.
But what I'm asking you is who should be doing that, because clearly somebody should be doing that.
Well, can I make another point? I mean, you say somebody should be doing it. I mean, if we're raising bank rate, we're doing it because we want to slow the economy down.
Yes,
so
absolutely.
We can't offset if we offset every ill effect of it, then we won't achieve that. Now, I agree that you know, the lenders have to give some thought to, you know, nobody wants to suddenly raise their standard variable rate hugely and find that lots of people come into bad loans, because that's enormously costly. And so, of course, you will be thinking about that and trying to judge the risk. It's not clear to me that the government is in a better place to do that than the lenders.
I'll just take a little bit of issue with what Kate said about raising interest rates because we want to slow the economy down. I think there are circumstances in which you may be raising interest rates in that environment, but there is this medium-term strategic challenge that I'm not sure, as we don't really know what it's like moving interest rates around at this very low level, what the balance of swings and roundabouts would be between savers and borrowers, and how it would play out. And I think, you know, the MPC would be having to feel its way a bit and take into account some of the things that you're talking about. I think if the financial health of the banks is improving and has improved, and we had some reasonably good reports recently, it makes it easier, I think, for the banks to accept that, you know, the margin would gradually diminish over time, and which is, I think, the effect that you're looking for.
Exactly, that's precisely it, because the point is, with base rate at 0.5%, it's very different from when it's at, say, 8% and you're thinking about moving it to 7.5%. When it's at 0.5%, nobody really knows, is it making a huge difference to the economy or isn't it? And what we've got surely to get to is in a position where there are firmly, interest rates are now firmly impacting on the economy again. And nobody's quite sure whether at 0.5%, whether they are or not. And the point I want to make, the reason for asking you about that, who should be urging the banks to just hang on in there and not just immediately respond just because base rate's gone up, doesn't mean you have to put up all your variable rates, you're already making a historically large margin. And just to finish off on that, because I was in the markets myself, and of course on the way in you had very happy gilts traders saw a big buyer out there. So as you did more and more QE, there's a massive buyer, so therefore prices get pushed significantly upwards and yields go significantly down. So that's how the markets impact on us. And there's been all this talk of whether it's brilliant economic management, but actually it's the reality of the markets. If they see there's a big buyer, they will push the price up because they make more money, and therefore the yield comes down. That's how markets work. So therefore, on the way out, and Governor King told us in this committee that he would put up base rate by 0.25%, and then he would unwind QE. That would be his way of calming the economy. Now, is it not the case that what's going to happen as a result of the markets is the gilts traders will see right now there's a seller out there. So what's going to happen is that the price is going to shoot down and the yield is going to shoot up, like, all sorts of analogies of things that shoot around the place. And that's what's going to happen. I was going to say something very out of order, but that's what will happen because of the market impact. And therefore, the yield curve is going to completely... is this not correct? The yield curve will go like that instantly. And if at the same time you've got base rates looking as if they're moving up, it becomes another field day for the banks, and it's an absolute disaster for the real economy. And so that's my point, is that in that scenario, the day we put up base rate a tiny bit, everybody looks at, right, now we're going to unwind QE, and we have a disastrous picture on our hands.
Well, that is why the bank would have to... Why I made the point earlier about the fact that the bank would probably announce the process of unwinding, which it would discuss with the DMO, and which I suspect actually would be quite modest, because... But it's already announced. Because they would be very anxious... Yeah, but they haven't announced anything about the pace.
Not the timing, no, but they've already talked about the process.
Yes, but they haven't talked about the pace, how much they would wish to do. And we don't either, if I may say so, know the circumstance in which we will get to this. So I completely agree with you that this risk is out there, and I'm sure I'm completely sure that the MPC will be very sensitive to it. That, I think, is part of the reason why we didn't see rates raised in the period that Andrea Leadsom, to some extent, I thought might have been desirable a year or so ago, because of this real worry about disturbing the curve and the fact that the first move will have a bigger shock. But I find it terribly difficult to know what one can do about it, other than to say, and it will really matter what the bank says about its intentions at that time. And that is, frankly, the only thing you can do. I want to come back and make a point. I should have made an answer to your earlier point about bank rate and other rates. Of course, the thing we didn't talk about, though, is, of course, bank funding costs, which are also not necessary. Of course, they're lower now because of the FLS. Prior to the FLS, they were certainly not at a half, and that is one of the reasons why we've had these difficulties and uncertainties in the market. And what banks' funding costs are at the time we get these movements in bank rate will also be important in the rates that they apply to both savers and borrowers.
Yeah, and completely agree with that, but FLS in itself is creating more profit for the banks, isn't it, at present, because the margins are still historically high. Completely accept that prior to FLS, their own funding costs were high. But we've actually now got a very interventionist marketplace where, the banks are really, making a lot of money out of this because their margins are still high. There isn't the market pressure as yet. You've seen them slightly reduced, but certainly the SMEs I'm talking to are just seeing funding is now available as opposed to not available. It's still very expensive. So the banks are basically pocketing the difference and using it to mend their balance sheets and all the things that they need to do. But it's not changing the fact that the second we indicate that we've turned the corner, we end up where the markets create a real problem.
I think that's absolutely true as far as QE is concerned. To go back to the point about margins today, of course, mortgage rates have moved down more significantly, I think, than SME lending rates, and that's not surprising. I think people see mortgage lending as a better bet, whereas lending to SMEs in this rather uncertain and lack of confidence economic environment is still seen as more risky, and it is, after all, SME lending where the banks have taken the bulk of their losses.
Yeah, I was just going to pick up on the point that Kate made about communication. I know you can say, well, the markets won't necessarily follow exactly what the MPC is saying, but this is where a circumstance in which very good and clear communication is going to be important. And I think associated with that, it's very important that the bank does maintain its credibility, such that the markets do have confidence that when it's making statements that it will follow through on those actions. So these, I think when we get round to this exit, I think the whole communications and credibility of the bank is going to be a very important issue.
But is it, I'm just trying to press you, should there not be? Because here really, I personally feel that QE is part fiscal policy and part monetary policy. And isn't it the case that in the unwind, it really does stray into fiscal territory? Because in a sense, it boils down to markets and who pays and the balance between how the monetary system hurts the private families and so on. So I understand what you're saying, there needs to be good communication, but is that enough? Does there not need to be a very clear strategy to avoid the kind of meltdown of the yield curve shooting up and margins going out and people being foreclosed on?
The organisation that the bank would need to work closely with is the DMO, Debt Management Office, and to make sure that its programme of sales of government bonds fits in with the DMO. I think the governor has always acknowledged that, and indeed there was cooperation when the bank was purchasing bonds. So I think that's the key link that needs to be maintained to ensure that the market's behaving in an orderly fashion. I think the links with fiscal policy more broadly, I think, is a slightly different issue.
Just on a slightly different tack, Ms Barker, with your interest in the home loan markets and in sort of housing policy, I'm just wondering, what do you think is the difference on the economy between the fact that, as I understand it in the States, there are a lot of home loans based on long-term interest rates, which have therefore had a direct impact from QE, versus in the UK where they tend to be more based or 50-50 on short-term interest rates and therefore have had less of an impact from QE. Would you say that that means that in the UK there's been more of a kind of penalty for savers versus help for borrowers, or vice versa? What, in terms of the savers and lenders differential in impact in the US and the UK, would you say there is a big difference or not? You've just asked a question which I have to confess I've given no previous thought. You also asked in quite a complex way. I'm not sure that I think that particularly because QE has mostly had an effect on long rates, and because in fact the general effect of QE is in any case about trying to bolster the economy. It's not, it's kind of now. Of course, now people who have long-term mortgages in the US, of course, have the ability to repay them and move down the yield curve. I'm not sure that really makes that. I'm not really sure it makes a tremendous. I'm not actually sure it makes a tremendous difference. I think the way in which the mechanism works has much more to do, frankly, with the strength of the banks in both countries, not particularly to do with the structure of the mortgage market. I think that's my answer. Okay. The point I'm trying to get at is, in the UK, we had some very interesting evidence from Ros Altman, who was saying that actually what QE has done is it has suppressed consumption because the over 50s tend to be the ones who've paid off their mortgages and who've got cash to spend. And because of the threatened impact on their annuity rates, they're saving rather than spending. Whereas at the short end, because people do tend to have mortgage rates that float, or at least fixed a base rate as opposed to the longer-term gilt rates, that therefore young people haven't really benefited from QE per se, they've just benefited from a lower base rate. Whereas older people have been harmed by the low rates at the long end. And so to ask it another way, is that therefore more intense in the UK than it has been in the US? Is that I'm afraid I don't know whether it's been more intense in the UK than in the US, but I would say here that even younger people will have benefited from QE to the extent that it has helped the economy grow, to maintain confidence in the economy and to maintain confidence in the financial system, and enabled banks to go on lending to people at all. And of course a number of people now in the present circumstances started to take out their
mortgages in any case at fixed rates. So I think to say that QE, because it stopped operating on the short-term rate, has not had any further effect on people's ability, younger people, to borrow, isn't quite right, because it certainly had an effect on the availability and supply of mortgages. I know that you will say, well, mortgage credit has remained very tight. Without QE, it could very well have remained even tighter. Now, I also agree that it's had a very negative effect on savers, and they have had to cut their consumption. I commented earlier that I remain somewhat uncertain about exactly what the effect of pushing rates quite so low is. Probably, we know that whenever you move rates, when we moved rates in the past, it always had a differential effect on savers and borrowers, and the belief was it had more of an effect on borrowers because you saw them as credit constrained. Now, because the effect on savers has been so extreme, it may very well be that they have reacted more than they normally would, and therefore that the balance between savers and borrowers has not been quite the same. That's the sort of point about about low interest rates. But I am not at all sure that I really would recognise the effects from QE that Ros Altman set out as being right when I take the economy in the round. Absolutely don't deny it's had an effect on the ability of savers to consume. Whether or not that has been bad, or whether or not the effects of the economy as a whole have been bad or good, I still think the benefits have been greater than the costs.
But that's the counterfactual argument again, isn't it? That's just simply saying if we hadn't done it, things would have been a lot worse. But I mean,
well, yes, but I mean, I don't think. But I think to dismiss that argument just by saying that's the counterfactual argument is not.
I'm not dismissing it.
Yes.
What I'm really trying to get at is the fact that.
One will go.
Yeah. Is the fact
Why
that.
don't you do this one?
I'll try.
It is straying into people's real lives, isn't it?
But
I mean,
monetary policy always, frankly, always strays into people's real lives. I mean, when I was younger and had a big mortgage, my life was strayed into very substantially by the rise in interest rates. We had to calm inflation down.
Yes,
to the point of bankruptcy. I mean, that's how it is.
The fundamental point is, although you're being very polite about it, you don't agree with Ros Altman.
I didn't think I was being all that polite, actually. You're quite right, I don't agree with Ros Altman.
Well, you said you're not sure, but you are actually very sure.
I'm quite sure that there have been bad effects on savers. I'm pretty sure that the effects of the economy as a whole have been positive.
And poor Dr. Sentance hasn't been allowed to say anything for some time, and I know that the next question will be for Kate Barker, so I'm going to bring you in.
I would take a slightly different view. I think the effects that Ros Altman is talking about are clearly potential effects of QE, and she's done some research, I think, that's suggested that there has been some effects of this sort. And I think this situation comes about not from having done a sort of short burst of QE and then sort of moving back to normal, but the fact that we're in this period of very ultra-loose monetary policy which has gone on for a long time. And I think once that period does go on for a long time, you begin to see some of these adjustments in parts of the economy perhaps where you hadn't normally expected to see a response to monetary policy. So I think we do have to keep an open mind about how positive for the economy a continuing period of low interest rates with further injections of QE could really be. I'm not sure, as we've said earlier, this is really going to provide much more stimulus to the economy.
We've had a good cant around that, actually almost 20 minutes. But if you like, one more very quick question.
Well, it's actually the fact that it's actually the issue of accountability is the final question. Is the thing is, as you both said in earlier answers, we've now effectively given the central bank a huge amount of responsibility, and with, as you've just said, no accountability, Ms. Barker, because in effect you're laughing at the fact that obviously monetary policy affects people.
I think the idea that I was laughing at it is not right. I described what in my life was an extremely painful experience. It's not remotely funny, and I'm describing what happens when you let inflation get out of control. Indeed, I wanted to beat my breast about it, since I think we ran monetary policy rather badly running up to the crisis. I feel terrible about the way in which this has all worked out, if you really want to know. I don't find anything about this funny or amusing at all. But I am making the point that it's not new that monetary policy has very differential effects on different people.
But where's the accountability?
You just a moment, Andrea, and you think monetary policy should have been tighter in the run-up to the crisis?
Yes, I do.
Substantially tighter, presumably, if you think that you didn't run it well.
Because
the odd 0.5% wouldn't have made much difference to the confidence effects that you were trying to knock.
It might very well have had to be substantially tied. But I doubt whether we could have done it in the UK alone, since it was a global issue.
Yes, but I am going to bring Andrea. Back really for a very quick question, if you can frame it.
Yeah,
quickly.
but it is. Where is the accountability? You know,
Well, I think we do have accountability mechanisms for the various functions that the bank fulfills, and I think that they're very important. And one of them for the MPC is these letter exchanges, for example. And I would have liked them to see a bit more, perhaps, pushback from the Chancellor when the MPC were writing letters to say, inflation is going to be above the target, it'll come back, and perhaps the Chancellor to show a bit more concern that was actually going to happen and materialise. So there are accountability mechanisms for the Financial Policy Committee as well. But the larger and the more complex the bank's responsibility gets, the more challenging it is to operate in that environment.
I was going to ask you about accountability with respect to the internal arrangements within the bank. Now we have such a complex set of relationships between the PRA, the FPC and the MPC, with shared chairman of some and membership of all and membership of some and all that. But rather than do that, rather than prolong it now, I might come back to you. Yes, I might come back to you with a few thoughts on that after the meeting to see whether you've got anything you'd like to tell the committee.